Standard & Poor's is clearly feeling pretty bullish about the Irish economy as it has decided to give Ireland back its A rating to Irish sovereign debt. Now, the agency is expecting NAMA to increase the pace of bond redemptions this year, with the hope there will be a rapid fall in the levels of general government debt to GDP. Today I'm joined by Philip O'Sullivan, Chief Economist at Investec in Dublin. So Philip, do you think the upgrade is well deserved?
Yeah, I do. I do think that the upgrade is deserved, but in saying that, I do think it's very much overdue because I think it does represent a significant element of catch-up by the ratings agencies. Ireland's 10-year bond yield peaked at 13.8% in July 2011, shortly after Ireland was downgraded to junk by Moody's, and obviously the bond yield performance of all peripheral countries has been very impressive since then. But in Ireland's case, our 10-year bond yield has gone down to just 2.43% today, which is pretty much the lowest level in history. So there has been a dramatic transformation in bond yields, and we have most of that adjustment was done while Ireland was still rated junk by Moody's, the biggest of the big three. Moody's didn't put Ireland back to investment grade until January. It's upgraded another 2 notches in May, and then earlier this month we did have that move from S&P, which was the first of the rating agencies to put us back on an A rating since Ireland returned to the bond market in 2012. So I think it is an element of catch-up, but I do think that it's a warranted explanation that they have given in terms of the improved growth outlook and the reduction in contingent liabilities, chiefly NAMA amongst those.
And Philip, what sort of impact will the recent ECB cut have on mortgages?
Yeah, I think you have to look at it in a number of ways. In terms of people who already have mortgages, about 54% of the stock of mortgages in issue in Ireland are actually trackers, which are linked to the ECB base rate. So all of those households will be getting an immediate adjustment as a result of the ECB rate cut. So that's something that will be kind of beneficial in terms of household budgets, but it won't necessarily translate into a proportionate increase in consumer spending, because we do have a very significant problem of household debt in Ireland, and I think a lot of kind of surplus cash that households have is being diverted to addressing these kind of legacy borrowings, and that's something that we have seen reflected in a lot of central bank data since the recession began, and also it's continued since Ireland came back into growth. So that's something just to bear in mind. In terms of new lending, I think that the Irish banks they've really been trying to secure or raise the margins on new business to try to improve their underlying profitability. So in terms of new SVRs, which are effectively the main mortgage product in the market at the moment, the typical rate would be about 4.5% for 25-year money, which is obviously quite a good bit above the ECB rate. So basically the SVR here in Ireland on new mortgages hasn't really had a tight relationship with the ECB, so I don't think it's going to do a whole lot in terms of new business, but it certainly will be a help for the 54% of existing mortgage holders who are on trackers.
And what are your views on consumer and business sentiment?
Yeah, we've seen some very impressive readings actually on the consumer and business sentiment fronts in recent months. The consumer sentiment index reached its all-time high a few months ago, but there has been some criticism of it that it hasn't really, tracked the trends in retail sales over the period. I think that, to a certain extent, that does reflect some of what I said earlier about a lot of households are focused on paying down debt. There is also a very powerful wealth effect out of housing in Ireland. There's been some research out of the central bank this week on that very topic. So I think a lot of people are probably feeling more confident about their prospects, given that the economy is adding jobs. The house prices are going back up again. But in terms of actually translating into retail sales, you really only just started to see that happening, and it's particularly encouraging to see things like car sales have shot up. In the first 5 months of this year, new car registrations were up by 27% year on year, and within that, just from a business sentiment perspective, it was interesting to see that new licenses of goods vehicles were up about 40% year on year in the first 5 months of 2014. So that's something that's, I think, is kind of reflecting that the turn in consumer sentiment that we began to see in late 2012 and throughout 2013 is now finally translating into hard spending, But it's like the old saying goes, consumer or confidence rises or grows as slowly as a coconut tree grows, but it can fall as quickly as a coconut falls from the same tree. So it's something to just bear in mind. It is moving in the right direction, but it is obviously remaining very fragile.
Philip, thank you very much. Well, viewers, do stay tuned as we have plenty more just like this coming your way. See you very soon.